Well, welcome everybody. I'm Jack Lowenstein. I'm here with Nick Markiewicz. Apologies for the slightly late start, but we're going to get on with things. So I am the chairman of Morphic Ethical Equities. Nick is running the money. He's the important guy. And what a great year it's been. I just want to say that this has probably been one of the best years we've had since we launched the fund. I think we're up about 21% for the year to date, that's the financial year to date. And we've outperformed the market in a very difficult market by 11%, which for reasons I'll go into later is even more of an achievement than it sounds. So can you tell me what's really contributed to this excellent year we've had?
Yeah, I think there's a few different buckets and a few different ideas, but the biggest by far has been AI, which is artificial intelligence. So we've owned a whole bunch of different stocks that are levered to the theme of AI. We'll talk about that, I'm sure, in more detail later. But artificial intelligence has been a big driver. But I think what's been pleasing for us is it hasn't just been AI. We've also participated in the big gold rally at the end of last year. So we had some nice exposure there. And then even outside of that, we've had a few small, totally non-gold, non-AI related stocks that have also done quite well. So look, I would say if I was to sort of put some numbers around it, I think half the outperformance of the year has been AI. There's been some gold, but then also the rest has been non-AI as well. So it hasn't just been a one-trick pony, as it were. And pleasingly as well, the performance has been quite broad-based. It hasn't just been one stock go up tenfold that's contributed to the performance. It's been there's been quite broad contribution as well.
And of course, given the nature of the fund, which is really a mid-cap, smaller mid-cap fund, what is, a lot of people will be aware that there's been the best way to play this last couple of years has been to be in Nvidia, Google, and so on. We've been nowhere near those. It's all been from specific stock picking in specific stocks. Why don't we talk about a few of those stocks that have really done well?
Yeah, sure. So maybe again, starting with the AI side, if I look through the top 5 contributors on the AI side, 3 of those have been one called Nebius, one called Sharon AI, and then another one called Mastech. They're taking a step back with the AI trade. I suppose from relatively early on, one of the things I think we did do quite well at the start of this year was sort of identify where the pinch points were in the AI trade. And if you think about AI is all about rolling out GPUs and using GPUs for generative AI. To run GPUs, you need effectively power. GPUs are the computers that AI uses are required to operate AI or use AI. But GPUs require an extraordinary amount of power. And I think one of the things that we identified relatively early on was that power was likely to be one of the key pinch points in this whole trade. It's relatively, I wouldn't say easy, but you can actually scale up GPU production relatively exponentially. It's just a function of adding capacity into the various pinch points in the supply chain. But power is actually very, very difficult to scale as quickly. And so I think where we came from it from the start was power and all the power derivatives in the supply chain were where value was likely to accrue. And in the portfolio, we chose to express that in a number of different ways, but we either owned businesses that had existing power endowments from the utilities, and those are now very rare and very valuable. Or we owned businesses that had leverage to the AI and utility construction, which is required to, again, ramp power. Or we owned businesses that had operated what's called a GPU cloud, or they were called neo clouds. So between those sorts of areas, we've done quite well. Certainly, if I was to be fair, we've obviously missed a number of areas in the AI trade. We've had a big squeeze in memory and a big squeeze in a lot of other verticals within AI. But I think for a broader scorecard on how we've played AI, I think we've done okay. And certainly, I think we can talk about this later, I'm sure, but I certainly think there's a lot more to go in terms of how we've positioned the portfolio on that side. And If I look outside of AI, the big two trades have been Greatland Gold. I mentioned gold being a good performer before. Greatland Gold was effectively a recapitalization of a UK listed, almost micro cap. It was effectively an orphan stock in the UK, but it owned 30% of an interest in an Australian gold asset. They did a recapitalization in the UK to buy out the remaining 70% interest in that asset. And that transaction alone was highly accretive and was a very, very smart decision for them to do. They bought effectively an asset that was being sold by a much bigger company that didn't really care about what they were buying it, what they were selling it for. And they were the natural buyers of the asset. There wasn't really anyone else who could buy it. So they got it for a very, very good price. What subsequently happened and what we didn't foresee was that the gold price would do what it did.
So it's a value play that really rode on the back of a rising gold price.
It's what we would call a special situation in our parlance, and we managed to get in at a very attractive rate, and then we were very lucky with what the gold price did. But I like to use that example because that is one of the benefits of the strategy is we can go up and down the market cap stack, and that was a very small company that we were able to get a good size position in. And then finally, the last stock that we did quite well in last year was a Canadian fashion retailer called Aritzia.
That's amazing. Retail and fashion have both been absolute death zones. Tell me about what made Aritzia different.
Yeah, so as you just said, retail has been really hard going the last 12 months in the market. So to pick a stock that's not only done well but contributed really well has been been a really standout achievement, I think, for the portfolio. So Aritzia, for those who don't know, it's Canadian based. It's a women's fashion retailer, and it does multiple different sub brands within the group, and they target smart casual clothing that you might wear to work at affordable price points. And it's the concept or the brand itself is a real hit with professional women. There aren't too many other competing brands that have sort of really nailed the fashion and the price points together. I think what I guess we really attached or hung our hat on with that stock was not only was it a great brand or a relatively unique brand concept, but with retail, the best stories or best retail stories are the ones that have a distribution story. So I used to be a consumer analyst many years ago, and I quickly learned that picking brands that are hot or brands that are in vogue is not necessarily the best way to make money. It's picking retail concepts that are already very, very profitable, very successful, but those that have a big store rollout opportunity. So Aritzia was initially Canadian-based. They have 70 stores in Canada. They now have 70 stores in the US, and they're going to roll out another 70 stores. And just to give you some context as to that number, established retail brands in the US, think Wrangler, think Levi, think all the traditional retail names. Gap, exactly right. They have around 650 stores. They all peaked at about 1,000 stores when malls were still around. Banana Republic, Abercrombie. Yeah. Now they're down to around 650 stores each. And so you sort of put Aritzia's current 70 store footprint relative to that 650. And it gives you some idea as to where they could potentially grow in the future. So, the bottom line is when you find a concept that's working, very, very attractive unit economics, very, very quick store paybacks, and you have that big rollout opportunity, it generally works pretty well.
And when you've got the rollout, you typically get a unit price improvement because some of your costs are fixed in that thing. So
Correct. Yeah. So with retail, clothing stores actually generate very, very good gross margins, 70-80% contribution margins on the clothes themselves. Where they get unstuck is the fixed costs of running a store, and particularly when your sales start declining. Yeah. Whereas they have the opposite issue of same store sales are growing very, very nicely. their margins are very attractive, and they've got that big store rollout. So look, it's been a good success story. Obviously, with a retailer, they're not stocks that you hold forever. So we have,
unless it's Costco.
Unless it's Costco or Walmart back in the day.
Yeah.
But with a company like this, we're very cognizant that there's still a long way to go with the rollout story. And if tariffs do get wound back at some point, which maybe they will, their margins could grow again. But yeah, it's been a good story. We think there's more to go in the stock, but we've sort of been trimming that as the stock price has done very well.
I've generally been impressed that although we've made a lot of money from AI, there's been a lot of other stocks. It's not a one-trick pony. There are a lot of funds out there, one-trick ponies that have tremendous runs and then complete collapses. But we've had some very diversified holdings. And two of the ones that strike me are AerCap and Corpay. AerCap, we've done very well in this. I mean, AerCap is an aircraft leaser, and I was very worried when I saw that the largest US ultra low-cost carrier, Spirit, collapsed. Tell me, has that had any impact?
Short answer, no. So AerCap is one of the core holdings of the fund. The way, taking a step back, actually, the way I think about the AI trade and how we establish those positions in the fund and the weightings of those positions. Obviously AI is a high reward, but also high risk bet. And they're also quite volatile. So you don't want to have those stocks dominate the portfolio, and you don't want them at the top end of the portfolio. I mean, unless they grow into those positions, which they have in some cases. But the way I think about the portfolio is having a nice tail of high growth businesses that you think are going to do tremendously well. But then at the top end of the portfolio, you have what we would call more steady compounders that we think also have a nice future ahead of them, but they're far, far lower risk, and you can have much higher weights in them and still generate a really good return. So AerCap is a nice example of one of those where, as Jack mentioned, AerCap is the world's largest aircraft lessor. They buy aircraft from the OEMs like Airbus and Boeing, and then they lease them to airlines that don't buy their own aircraft, who borrow or rent the aircraft from AerCap. It's been a great story for a whole bunch of reasons, but the first is that through COVID, Airbus and Boeing lost effectively 2 years of production. And so when you lose 2 years of production in the aircraft industry, it's very, very difficult to ramp back up. And even to this day, they're still not producing, or they've only just started producing at the same rates as they were in 2019. Overlaying that, you've had travel demand, which has been going vertical over the last 5 years. Travel ordinarily grows at twice the rate of GDP. That's the average rate of travel growth over 70 years. And it's grown even more than that, or demand has grown even more than that since COVID. And that demand is still sustaining against an aircraft base that is only just recovering now. So what that's basically meant for AerCap, someone like AerCap, is a couple of things, but it's all been positive. One is that their leasing rates, or the yields that they charge on their assets or earn on their assets, have been going higher. That means that they charge more to airlines for their aircraft. Two is that the residual value of their aircraft has actually been going up. So it logically follows that if there's a shortage of aircraft in the world and demand's still very strong, then the value of the secondary value or residual value of aircraft is also going to be quite high. So you've had a situation where they've been progressively selling some of their older aircraft, which in previous times wouldn't have been worth much money, but they've been selling it for twice the book value that they've been carrying them at. And so when you put that all together, that makes for a really nice equation for the business, where they can keep growing their book value at very, very high rates, and they can very high yields, and they can sell off old aircraft above book. And why that made sense for us from an investment standpoint was, you could buy AerCap 2 years ago when we made the first investment. You bought it at a discount to book value, and they're actively selling their aircraft at twice book.
So book value is understated, and you're buying discount.
And the cherry on top with AerCap is that they have, in my personal opinion, one of the best management teams that I've ever met. So they recognise how to create value for shareholders, and they recognise that when the stock price is trading at a discount to book, but yet they're selling aircraft at twice book, the best use of that money is actually going and buying back your own stock. So they've been, what we in the industry would call cannibals of their own shares. They've been buying back an enormous amount of shares. Some quarters they buy back 5% of the company. And pleasingly for them is, or for us, watching them is a lot of management teams, when they're doing buybacks, get quite scared of buying back stock when there's a lot of volatility. They do the opposite. They actually go harder on their buyback and create a lot of value for shareholders. So, at the end of the day, what we've got here is effectively it's almost a bank with wings, I call it. They're growing book value per share very, very consistently in a very, very attractive market. And it's still not that expensive for the return on equity they're getting and the growth that they've had. So I love businesses like this in a market today where the reason AI has done so well is because A, there's growth in AI, but B, there's not much growth outside of AI. And so there's a big growth premium on AI. Whereas if you can find a high quality franchise with assets that you can actually value confidently, and you're not paying too much for it, it's a wonderful business to have at the top of the portfolio.
And I believe that the aircraft manufacturers, Boeing and Airbus, still have a massive backlog of orders, so they can't fill demand going up the next 10 years.
They have a 10-year backlog. So, that also gives us confidence to buy AerCap, knowing that you have a decade of the current conditions ahead of them.
And AerCap itself it's got a right to future production. It's already bought through options and so on.
Correct. And that's the other thing about AerCap is every time there's a hiccup in the travel industry, which there is invariably every couple of years, they walk to the front of the queue and buy up options when a lot of the airlines walk away from their options. So yeah, it's a great story.
Right. Well, I want to now kind of, not exactly a mea culpa, but Morphic Ethical Equities is the only listed ethically screened global equities fund out there. When I designed the screens nearly 10 years ago now, one of the things I did was I excluded all the fossil fuel companies and nuclear, which have obviously done pretty well with times. I mean, how much does the fact that you couldn't invest in that hurt your performance, do you think?
It's impacted performance in a relative sense, but not actually that much, because the oil and gas sector relative to the benchmark is only around 4%.
Yeah.
So it's very, very small. And the last time I looked at it was around a 60 basis point impact. So not
disastrous.
Not disastrous, no.
And the other thing about our mandate that you have to work to is that the mandate says you've got to have at least 5% of the fund in companies that are trying to make the world a better place, to use it to give a broad expression. What stocks have you got in the fund that are actually doing that at the moment?
Yeah, I mean, look, you can you can interpret this question many ways with a lot of the companies, because they all have big ESG decks and tell you how good they're doing for the world. But if I think specific companies that are directly contributing to making the world a cleaner, safer, better place, I'll point you to maybe one like Clean Harbor. So Clean Harbor is a US waste business. They dispose of hazardous waste. They are one of the few licensed businesses in the US that can do that safely and in a clean fashion.
And accountable, hopefully.
And accountable. But one of the big growth areas for them is PFAS. So getting rid of toxic chemicals that are being, as old sites get remediated.
These are the forever chemicals that I think 3M used to make.
Correct. So these forever chemicals that are very nasty, very toxic, and exist on a lot of industrial sites and a lot of government sites as well in the US. Clean Harbor is one of the few that can actually dispose of these chemicals, do it safely, and importantly for us, do it profitably as well. So it's an example of a business that's, I think, contributing positively to the world and the environment, but also doing it profitably for shareholders. And again, for us, we don't just buy businesses on the narrative; they have to stack up on their valuation as well. And certainly, the stock is the company is not expensive for the growth that we think they're going to get.
And regulated growth in effect, because they're as a almost monopoly provider of the service, that there's not many people who come in and compete with them, and there's a growing demand.
Correct. And look, you can make the same argument for companies like GFL. GFL is a Canadian waste company that also has US waste sites. They are also involved in liquid and hazardous waste disposal, not to the same extent as Clean Harbour, but there's lots of companies in the portfolio that I think are levered to a world of net zero and of waste disposal and things like that.
Let's talk a bit. We've talked about a lot of stocks that have been in America or in Canada. What about? I noticed you've made quite a lot of money this year in Japan. Talk about what you've done in Japan and how well that's gone. It's obviously been a reasonably good market anyway, but you seem to have done better than the market. Tell me about that.
Yeah, so I mean, Japan has been in a bull market, so it's sort of almost felt a bit this year like you could poke a stick in Japan and make money. But look, we've done okay in Japan. There's sort of been three companies there that have done quite well. One is, I guess, on the AI side of things. When everyone looks at AI today, they look at the United States and what the big name brands like Microsoft and Amazon and NVIDIA are doing, even though NVIDIA is a Taiwanese company. But not many people realize that the AI supply chain, a lot of the niche critical components in the AI supply chain actually come out of Korea and Japan. And within Japan, we've managed to find a small number of high quality AI related businesses. So we own a business called Anritsu. Anritsu make testing equipment for optical transceiver businesses, and they have a 2/3 market share of the testing equipment for that small part of the industry. So they dominate a pinch point, and up until recently was a relatively small and unnoticed business. So in Japan, we've made good money on the AI trade, but we've also made money on, we own Resona, a Japanese bank, and that's been
the worst bank in Japan.
Well,
it was the worst bank in Japan.
Could have been, but it's been one of the best performing banks. Look, Japan has been going through a 20-30 year period of effectively zero interest rates and very low net interest margins for the banks, and also low loan book growth as well. That's now started to reverse. So you've got the Bank of Japan is now looking to raise interest rates. The spreads that banks can earn are now going higher, but also most importantly, their loan books are now growing again. So Resona actually reported last night their loan book's growing 7%. Their ROEs at return on equities at 10%, but they're targeting 12%. So now earning a very, very nice spread relative to their cost of equity.
And what's the price to book?
Price to book today is around 1.5, 1.6 times. It's gone up, but certainly when you're earning 50% more than your cost of equity with a 7% loan book growth, it's still, I think, still going to do okay over the next couple of years. So Resona's been one, and then we also have an industrial automation company called Daifuku. They install and service and design all the automation equipment that goes into factories, plants, things like that. As has been the case for a lot of our stocks, they had a very small component of their business that did clean rooms, which is the automation part of GPU manufacturing. That's gone from a very small percent to a very large percentage of their business, and it's been re-rated as an AI trade. But we didn't buy it for those reasons. It's been a happy coincidence, but they've got their fingers in a lot of different pies, and they should do well outside of AI as we see reindustrialization in the US and continued industrialization in China, and specifically within that automation of factories. So again, a business that's done very well. It's a niche business, sort of there's a few plays in the US, but it's one of the few in Japan, and it's still growing very nicely.
Well, I'm conscious of time. As we come to the end of this webinar, perhaps you can talk to me about how you see the year ahead. And obviously you can't say what you're going to buy in the portfolio, but what changes do you see in the year ahead in terms of the positioning, likely positioning, and the challenges and so on?
So, I think I'll start with AI because we started the webinar talking about AI. But look, I think the big bet in the market over the next 12 months is, where does AI go? And if I think about AI, only in the last 3 months has the market really got bullish on AI. And it's got bullish because there are now actually useful practical applications being developed by the AI labs that are actually having real tangible impacts and benefits on the users. That's only just started. That being said, the market has run very, very hard on that theme already. I think the market is, the easy money in AI has likely been made. I think the market now from here is likely to get quite discerning on where the beneficiaries in AI are. So I'm pleased to say that I think we own a lot of pinch points in the AI stack that are still relatively undervalued. So particularly a lot of our power names that aren't fully valued relative to their power pipeline. So I think the market is likely to be quite discerning and look to where there is latent value. But it's certainly not going to be as much of a free ride, I don't think, as it has been.
Only free if you got on the train.
Yes, exactly right. But it didn't feel free at the time. It felt quite uncomfortable.
White knuckle, maybe even.
And then outside of AI, if you look at the broader US economy, the US economy is actually doing okay. EPS growth is very high. It's actually 20%. But even if you strip out the hyperscalers and the larger companies, EPS growth is still actually okay. What's happened in the market over the last 12 months is, because everyone's got so excited about AI, they've forgotten about a lot of the industrial businesses that are actually doing quite well still. So I suspect you may see at some point a reversion back to some of these businesses that are still growing very nicely. But because people are excited about AI, they've sort of forgotten about that part of the market. So for us in our portfolio, yes, while we're still quite bullish on AI and we still own what I think are good companies within AI, we're actually starting to increase our weight to some of these more stable defensive growers that we think are becoming quite cheap. So, I think absent another flare up in the Middle East or another curveball that Trump might throw us, I think the outlook for equities is actually okay. I think the challenge is getting the balance between AI and non-AI right.
Excellent. Well, thank you very much, everybody, for attending. We'll see you all hopefully at our annual general meeting, probably in November. Around the same time, we'll have another of these webinars and another catch up. Thank you very much indeed. And thank you, Nick, for what has been an excellent 12 months or so. And keep it up.
I'll try.
Very good. Thank you very much. Bye-bye.